Hello, ladies and gentlemen. Welcome back, I should say. I know some of you might not have joined us for the initial webinar that we had on credit spreads, the basics, or you might not have watched our part one series on Beyond the Basics as well. But for those of you that did, I'll say welcome back to our presentation today for credit spreads, Beyond the Basics part two. For those of you who are just joining us, first time joining us, if you don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. Now, throughout this month, we shared with you a breakdown of just the basics of credit spreads. This came about, of course, from a comment that was made on one of our previous YouTube videos, debit spreads versus credit spreads. And the comment was that why does it need to be so complicated? Why can't we just look at something? No wonder people can't make money with this strategy or with other strategies. It's too complicated. So our goal was to break it down to just the basics in the first presentation. And then in part one, we went beyond the basics. Using our tools at Power Options, the concepts and our knowledge of options investing, we presented structure and criteria inside a bull put credit spread that showed us a better performing track record over the last year. Now, these webinars are designed to give you an introduction to spreads, as well as a guide to what is possible, what realistic expectations should be for spread traders, what does work, what we saw that did work, and what we saw that did not work. Now, as we continue beyond the basics, in part one, we looked at bull put spreads, and we looked at our preferred criteria and showed the results of what would have worked in 2018. Today, we're going to look at some of the results from bear call spreads, what did and what did not work, and why it did or did not work. We're going to take a look at some parity trade concepts, and we're going to answer some questions that came in, as well as others that come in during the webinar. If you do have a question, a comment, a thought at any time, I do encourage you to use the question pod. When you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod. Just use that to type me in a question. I'll be checking it consistently throughout the presentation. I want to start off with a YouTube comment that came in from part one. Now, I have not answered this directly on YouTube yet, but on the posted webinar for part one of Beyond the Basics, Surge472 commented, if one strategy worked best in 2018, it doesn't mean it will work best in 2019, or even work best in 2017. Each year, each month, each day, the best strategy is different. You got those results primarily because you chose the date range, January 1st to December 31st. It's actually December 29th. We didn't open a new cycle on December 31st, but that's fine. Not because of the strategy. If you started in February and ended in November, the results might have been the opposite. Okay, well, I'm going to be honest. The comment is not wrong. Let's take the first part of it. If one strategy worked best in 18, it doesn't mean it will work best in 2019 or even worked in 2017. Correct. The market is going to be different. We know that. And I did not say this was the best strategy for 2018, what we showed in part one on the bull put spreads. If we look at the same chart we used to illustrate SPY, and don't worry, we'll reference that again in today's discussion. An investor trading long straddles or long strangles, or legging into long puts and long calls may have well exceeded what we showed for bull put spreads. The purpose of credit spreads, the basics, and credit spreads beyond the basics part one, is not to show the best strategy for 2018, but to show that investors could make credit spreads work for them in 2018, as difficult as the market was, with the right criteria. For those interested in spread trades, what did work and what didn't work, and also consistently. Now, let's follow on with the rest of the comment. Serge said, Each year, each month, each day, the best strategy is different. Got those results because you chose a date range, not because of the strategy. Okay, well, let's start off with that. Indeed. But if you follow our webinars, and I know there's a lot of them, but you know I showed the results of the same bull put and bear call credit spread criteria we're going to look at the beginning of 2018. We showed how the weekly bull put criteria that we show in Power Options, compared to other criteria sets, other thoughts that investors, myself, and Power Options subscribers thought would work better over 2015 through the end of 2017. I continue to show the results to share that, yes, these are the criteria that we use. This is why they're shown on Power Options as the default criteria in the bull put and the bear call search and have been consistently successful. Timing and other factors are important, and this part of the comment is correct. I showed it as a one-year time period just to show what would have happened with X over this time period and how it compared to going with a lower probability and a higher return. Would that have worked better over the same time frame? If we had just done bull puts on, say, SPY, Apple, a single stock, or just ETFs, would that have performed better than scanning across the universe of options to look for not only the right option criteria, but the right stock criteria? And in the 35 or so tests that we did, what we showed last week, the bull put weekly on Power Options with the stop in, was the highest return over that same time period. And for past webinars, it also gave us a better return for these other concepts and other ideas over 2015, 2016, and 2017. Okay? Now, a note on this. When we use this strategy testing tool to run these 35, 40 tests I'm talking about, each trade that would have matched the criteria is shown. The gain or loss as followed to expiration with or without a stop, portfolio balance at the end of each expiration cycle. So when I share the results, it's based on not only what I found to be the better results, but also because there was not a significant drawdown in the total portfolio that would have stopped me from trading the strategy. Okay? Here's a look at how our testing report pops out. And this is the strategy testing service that's available. If you have an idea of what you'd like to see in a strategy, what criteria and what stop you'd like to see over a 3, 4, 1 year, 1 month even, 2-year period, when we run the criteria in the test, it spits out the results. You know, we see here on February 8th, we are stopped out by a stop order on the AMAT bull put that was opened, and it took a 39% loss. But even during that crash, the bull put we had opened 11 to 14 days before February 9th on W day still expired, as did the position on Netflix. So they were still successful even with the drawdown from February 5th to February 9th. And then it gives us, for the next cycle, after those positions are closed, the current account value. This was the low for that testing period for the bull put weekly search with the stop entered. Starting with a $100,000 account, if you remember, we only allocated 20% of that total $100,000 portfolio to spread positions. We opened maybe 3 positions max each cycle. So the biggest drawdown was only about 6%, really about 5.3%. If this at one point had dropped below 80,000, with the losses taken in, how many contracts were allocated to each spread based on the margin requirement and the capital that we were allocating, if it ever dropped below 80,000, I would have stopped the test and not used it. Why? Because I was only allocating 20%. If it's not working out, I drop below that $20,000, I now have to borrow from other strategies, other allocations in my portfolio in order to continue going. Now, if it does continue down, and I did allow tests to run, of course, if it went below that mark, we'll see that in a minute, that was for analysis purposes and to show we had to do something better because it wasn't working. what we expected would work didn't. We needed to figure out why and how we could enhance it to give you a gauge of what does work both historically and what has worked over various time periods. All right, now, but again, the comment isn't wrong. The comment is right. Had I run any test for bull puts starting on February 1st, what would I have missed? I would have missed about 6 to 9 trades in the month of January that were successful and brought the account up to about $111,000, 10 to 15% increase for just the month of January. So instead of starting off in February and taking a hit of 5.3%, it would have been closer to 20%, 15%, somewhere in that line. I would have started off maybe $85,000. So that's correct, but this is why we offer the strategy testing services. So if you say, hey, I've got a strategy that's been working okay for me, what if I had done it at a different time frame? What if I had changed the criteria set a different way? Well, that's what we'd be able to show you. So in regards to that, I'm just saying that the comment was, to be a fair comparison, you should have shown it over different time frames. And this was done to be consistent, to show how these ideas would have worked over the same exact time frame, what did and did not work, and beyond. And skipped ahead there, but to the rest of the comment, again, to make that proper comparison, we need to look at the performance at different time frames on multiple stocks and indexes. Only then can we say with some certainty that one strategy was better than the other. And that is what we did in a sense. So the Power Options tools looked at our search criteria, opened the positions that would have matched the criteria from our historical database, showed how those positions would have resulted over the expiration. And the other tests that were run, some were done with no restrictions, no stop, no criteria for the stock. Other tests were done taking just a group of the highest performing stocks of 2018. Some tests were done just on the big indexes, RUT, NASDAQ, SPX, for example, DJX. Others were just doing ETFs, while other tests excluded indexes and ETFs. What I shared in part one was what gave us the best return over the time frame selected that was done for all tests, all same allocation, 20% of the $100,000, and what worked the best, and how we could improve that with different ideas on stops and so forth. So that was part one, but that kind of answers this comment. And lastly, of course, without all of that, it's just random trivia for 2018. The one certain fact, never be a 2018 again. What worked last year likely won't be the best performing again. And again, this is a correct comment. We have no idea what 2019 has in store for us. What we are showing you, and what we do know, is that over several time frames, consistently screening for spreads that have an 85% probability or higher vastly outperform higher return, lower probability spreads. We showed in last presentation how important the stock criteria was as well in relation to the bull puts, meaning that the most successful criteria we showed, the bull put weekly search, contains both the option criteria and some stock criteria. When we took out the stock criteria and left the option criteria in, just looking for spreads with an 85% probability and so forth, the results were a loss instead of a gain. And we all know that spread trades are risky. There are times when even with a stop, even with management in place, there are times when the unexpected will happen. You'll wake up in the morning and the stock might be below both put strike prices of your bull put or above both strike prices of your bear call, where you're at a 75 or 80% loss of what you invested in that spread, where the day before you were still out of the money and you were still looking at a potential profit a few days away. That's why we would ever only allocate a max of 20% of our total portfolio into spread trades. Usually I keep it around 15%. All right. Again, the one thing to keep in mind, the series is designed to help investors interested in spread trading get started on the right foot. If you are trading spreads, interested in trading spreads, what we have shown is what we feel is a consistent path going forward. There is no real way to determine the best strategy in any market, as Serge correctly pointed out. But hey, we keep looking for it. That's part of my job here. In the meantime, we're sharing what works for us and has kept us out of trouble with these spread positions. All that being said, what happened to the bear calls? In part one, we looked at bull puts, and we hinted at some complexities we were having with bear call spreads. Let's talk about the structure. Remember, in a bear call spread, we're going to look to sell an out-of-the-money call that's above the current stock price. At the same time, we're going to buy a further out-of-the-money call, which is above the sold call. I'm sorry that got cut off. We take in a net credit, and we look for a reasonable expectation of return. 13, 14, 15% maybe for 2 weeks out, 19 to 20 for maybe a month out, with a spread where that short option gives us that probability we want of above 85%, that the stock would stay below the strike price. Here's a spread we see on Apple, theoretical. Well, it's an actual trade from this morning, not a recommendation or suggestion, not a trade I entered, but it could have been entered this morning. I don't know if Apple has earnings coming up between now and then. I haven't checked. In any case, I may sell a 15th February expiration, about 22 days out, 165 call. The stock's trading at 152. So I'm about 12 points, $12.50 out of the money. And I might be able to sell this call for $1.03, $1.05. At the same time, we buy a higher strike, the 15th February 170 call for about 46 cents. We get a net credit of around 57, 58 cents, which gives me a 13.1% return. On the 5-point spread, my max risk would be $442. Frank says that Apple earnings are on Tuesday. Thank you, Frank. I appreciate that. So I would not enter this trade. It's just a visual example of the bear call structure. All right, so opposite of the bull put, what do we want to have happen? Hey, we want the stock to stay the same, move down in price. We gave ourselves some room so it can move up without getting threatened. But remember what we talked about in part one. The 2018 market, which again, Serge is right, we won't probably see this market again. 2019 is going to be different. There were great bear cycles. Right? We have this great trend in the beginning of February. We have this nice trend from March 21st through April 5th. Again at the end of May. Again here near the end of June. And we don't really see too much, do we? In this time period of beginning of July to the end of October. And then all the way through October and November. But if you're doing weeklies, or if you're doing 2 weeks out, even if you're doing a month out, there's some issues here with the bear calls. So let's say my cycle had me opening positions here, right at the end of September. Well, most of those would have been a loss, would have been stopped out, would have taken a loss in the first cycle. Oh, I'm sorry, with the bear calls, we would have been very profitable. Then we open the new positions. We might have hit the stop here as the stocks moved up or they needed to manage. If not, hey, we looked really good. And we open new bear calls here. And all three of them might have lost. So we might have won on 6 trades, selling 2-week out positions, 2 or 3 at a time. So profit on 6, then lose on 3. But remember, we're looking at sort of a 5-to-1 to 6-to-1 risk-reward ratio. We're probably losing, we probably stopped ourselves out, but we're still losing 4-to-1 against this. So this is actually 12 losses of those 3 that hit here. When we do bear calls again, we make profit. We open bear calls here, we lose on maybe another 2 or 3 trades. 4-to-1 ratio, we're losing 8 trades, 12 trades against the 6 we made here, the 3 we made here. And then if we open again, we looked pretty good. But if we're opening bear calls at the end of December and so forth. So why is this important? We all know that many investors out there, and rightfully so, if they're caught, will say that you can make more money in a bear market because they happen faster and they happen more steeply. If you timed it right and bought puts here, bought puts here, bought puts here, bought puts here, so on and so forth, didn't do anything here, maybe you bought calls and then followed the path again, you would have had majorly outsized returns. You would have been looking really good, but you have to catch them with the timing. The market was negative close to 50% of the year, meaning 6 out of the 12 months showed a negative market performance. But it wasn't really 50% of the time, was it? We can't say that 180 days out of the year were bearish and 180 days were bullish. This was a 4-day time period. This was a 3-day time period. This still continued down a little bit for another 4 or 5 days. That was good. This was a 3-day time period with the drop, and then it sort of stagnated. And then you saw more time frames. Even though this was pulling us down negative from where we were at the beginning of January after the first good strong month, they were sudden. So bear calls would have been successful, but then you've got twice as many days that it's bullish after that, then a sudden drop. Twice as many days it's bullish, sudden drop. We're still going negative in a sense, but it's happening quickly. And remember, with the spread trades, you're looking at that, even with the stops, you're looking at 3-to-1, 4-to-1 ratio. All right? So now here comes the dilemma. And it's not always straightforward, which is why we host these webinars in the hope to educate you as you're going into spread trades and you're learning bull puts, bear calls, what works best. If concepts of stock trend, probability, strike difference, time frame to expiration of spreads, 1 week, 2 week, 4 weeks, 2 months out in time, if it works better for one, it should work better for the other. We showed how important it was to use stock criteria, and we touched on that earlier. We want the better probability range. 85% spread probability or higher does outperform 75% in different markets, right? We talked about 2018, but we also showed in previous webinars it worked for 15, 16, and 17. We saw the results of not using a combination of option criteria and stock criteria. Just taking out the stock criteria turned a winning record into a losing record. You need to be in the right trend. And with the probability also goes with the correct expectation of profit. So if all of that worked, stocks in the downtrend using things like MACD, SMA, or EMA, correct expectation of profit, 85% probability, if that worked for bull puts in what we might consider a 50% up and 50% down market, a selected time frame, that would just naturally work for bear calls. We just have to reverse the stock. So taking a look at that, reversing the stock filters using the same criteria we'd want, probability of greater than 85, strike difference for our target, 8 to 17 days out, 2 weeks, which worked the best for the bull puts. But then now we look for stocks under the SMA 20 or the SMA 50 and a negative MACD crossover, and always, as Frank thankfully pointed out to us, avoid earnings between now and expiration because you don't want to get stuck in a directional trade with an event you absolutely cannot control. It's not worth the risk. All right, so the same things we did for the bull puts that showed us the best performance over that time frame, over 15 to 16 other tests, looking at different criteria, different probability sets, different stocks, just using index, and so forth, that should just work for the bear calls. Well, unfortunately, it didn't. Because of what we just discussed, with the fact that the bear markets do happen quickly, and I may make money during a bear cycle on 3 to 6 trades, the recovery to the bull side lasts twice as long, and when I start to lose on those spreads, even if I'm only losing on 25% of the spreads, but I'm taking 3, 4, or 5 times the loss of what I won. So 3 losses would wipe out 6 potential gains. Same time frame, starting with a $100,000 account, allocating only 20% of our portfolio. It's about 6% to the top 3 trades that matched our criteria. On December 29th, the ending amount was $65,000. So even with October's decline, November's decline, and December's, it was a 35% loss. Or, remember what I said, once I hit that 80,000 mark in the portfolio value, essentially losing the $20,000 I would have allocated, or the 20%, doesn't have to be a $100,000 count to trade spreads, just illustrating that, emphasizing you need the 20% or less. Because of this reason, even what you think would have worked, the market ended lower at the end of 2018 than it began. So the natural thought that bear call spreads will work better is not the case. The success rate on 73 trades, no stop, keep in mind, was 57 wins, a 78% win ratio. Remember what we saw in part 1. If I'm looking for spreads with an 85% probability or higher, I need a success rate of at least 82 or 83% to profit long term. Unfortunately, if you look for spreads with a 70 to 75% range, you need this sort of win ratio, 78%, to be profitable long term. Now, the average return on the winners was right in the ballpark of what we wanted with our realistic expectations. With no stops, though, this is what killed it. The loss on the losers was 96.3%. Even though there were only a couple sudden bullish spikes, which the biggest bullish spikes, believe it or not, if you remember, happened during that November and December timeframe. Right after the quick drop, we'd see the Dow drop 600 points. And the next day, we'd see it jump back up 200. There's one day it jumped up 1,000. And then it fell again 400. And so that is nerve-wracking for spread traders, okay? But from our discussion before, we know we have to do something here. This is a major issue. We can't allow that to happen. We have to control those losses, okay? We saw it before. We've at least got to keep it under 65%. We also need a better win ratio. And here's that discussion we wanted to have. Can a stop solve both problems at once? We're going to take that same criteria, same time frame, found the same trades, but we're going to use a simple stop this time. We're just going to stop the position for whatever the loss is if the stock hits the short call strike price. Not going to allow the short option to go in the money. The change is drastic. Same trades, stopping the ones that went to the near full loss. As soon as they hit the short call strike price, we do get a positive gain. Now, it's only up to 4.4%. The ending account value is 104,360, so 4.4% gain. But again, we only allocated 20%. So in this case, we could say it's a 21.8% return on what we had invested. The success rate moves up. It goes from 57 wins to 65. On 80 trades, why are there more trades? All right, this is something that's a little bit subtle. Why are there more trades? Because what we did is when the stop was hit and a position was closed, the system would automatically take that allocation and open the next new trade, whatever day it was, to find a new position. So we entered 7 more trades. Makes sense. We had 57 losses, remember. So we increased this by 8. And so that also means that at times we would have been opening more trades more quickly rather than waiting just to the next expiration cycle. Okay, so that's why there's 7 more trades. The return on the winners moved up from 14.4, I believe it was, to 15.5, and we controlled the losses to what we needed. We still took a 52.6% loss. I want to talk about this briefly. I don't have a slide for it. I'm going to talk about this briefly. And naturally say, well, you're going to do better if you control this to only 25%. But now we're in a problem. If I set my stop too low or some investors like to use the net credit. If you received a 40-cent net credit, you might put a stop if the buyback cost of the spread, buying to close the short, selling to close the long, reaches 80 cents or 2 times the net credit. Now the problem is you'll control your average losses down to 25%, but you're going to cut this down drastically. You won't have 65 winners because a lot of the winners would have been fluctuating. You would have stopped them out for a loss. Your win ratio is only going to be 50 out of 80 trades. And that's, even with limiting a risk, we're not allowing the winners to help us as much as they should be. So that's some of the risk, and we'll address that in our next webinar in this series. All right. So we still need to improve. We saw a result that could reach us 4.4% return, or 22% roughly if you think about it, against the investment of 20% of the portfolio. Earlier I mentioned 35 tests were done. This includes bull puts and bear calls, but about 20 to 21 of the tests were for bear calls only to find any consistent success. What we saw with the bull puts did hold true for bear calls. Looking for the lower probability and the higher return. Instead of looking for about a 15% return with an 85% probability, if you looked for a 25 to 30% return with a 75% probability, it was worse, even with the stop. If we selected only 1 or 2 stocks, or a list of 5 stocks that performed bearishly, good bearish percentage-wise over 2018, the results were worse. If we just did bear calls on broad-based indexes and ETFs with the probability of 85% higher, we did better. This is with the stop, but it was still a loss. The loss was around 78,400 or 21.6%, below the 20% we would have let it go. The same option criteria, 85% probability, which has consistently shown us better performing in this market, but also we showed this for 2015, 16, and 17 as well. And in any case, using different moving averages, bearish trends, looking for Bollinger Bands, trying to pick stocks that were at their 52-week high, hoping that they'd fall down. All right, so instead of bottom feeding on a stock that's hit the bottom and say, hey, let me sell naked puts because the stock's got to rebound up, what if we hit the highest peak when a stock's peaking up at its 52-week high and then trying to do a bear call as it goes down? The best ending with a stop in place, because that worked for our better results, was still a loss of around 11.9%, dropped down to 88,000. Using just inverse ETFs. So what am I saying here? Well, it's not, the bears aren't working. Looking for bearish stocks and doing the bear call spreads wasn't consistent because of the timing. Again, this does support what Serge commented on. So why don't we just take the reverse? Why don't we just look for inverse ETFs? Well, it's funny because the inverse, doing this just on inverse ETFs, allowing 2 times and 3 times inverse ETFs showed the highest return, but also the lowest low end, down to about $61,000 at one point. Almost doubling what you would have allocated to the positions. You would have had to borrow another $20,000 from what you were doing in your other part of your portfolio to continue on to try to make it work. So again, there were great times to be in bear call spreads. Long term, just saying that you feel the market is bearish in 2018 would not have worked to the expectations. Maybe, as Serge mentioned, if we had started just on February 1st and got the big spike and started off ahead, we would have done better. Because we took losses in the first month because it was still a bullish market. Okay? But one strategy alone did not meet the goals. We do have to be willing to switch with different markets, but that makes it complex to pick the proper timing. I don't know anyone personally who picked this volatility collapse, this volatility spike that we saw the VIX shoot up to about 32, 36, I believe, and the markets collapsed. I don't know who saw that coming. I don't know who predicted well. Now, after the first day, we said, wait, something's going on. This could continue. We put ourselves in position for that, naturally. But that first day, that first sudden collapse, I don't know anyone who saw it coming and caught it exactly. There are people who might have said, yeah, we've been on a good run. Let's see if this next month is bearish. Let me buy some puts here. Let me buy some SPY. I bought VIX calls back here. That worked out really well. But again, what we're trying to show is that is there a way we could have been successful with bear calls as a lone strategy? And the answer is yes. Might not have met our goals, but with the proper criteria, the proper structure, which you need to be aware of when going forward with spread trades, there was a way that worked. But long term, we have to be willing to go in and out of strategies at time or step away. Many of you heard me say towards the end of the year, I stopped trading spreads entirely after mid-October. I didn't do bull or bear for November or December or Iron Condors as well. Which leads me to another question that came in via email after the first part of Beyond the Basics was posted. Via email, Todd asked, although you showed bull puts, wouldn't you have done better with Iron Condors with the increased returns? And the answer is not exactly. Look how hard it was to find any good return with bear calls because of the timing, because of the cycles that were bearish were fast and rapid and had twice as long of a growth period after that. Maybe not as sharp, but it was still twice as long. We see a 5-day decrease. It's followed by a 10-day increase with maybe some hiccups in there, but overall it's a 10-day, 12-day bull. And then a sudden 3 or 4-day bear followed by a 12 or 15-day bull. Okay? So the Iron Condor compares the two. It takes a bull put and a bear call, and we combine them together. Okay, that's an Iron Condor for those of you that are not aware. I'm still doing a bull put. I'm still doing a bear call. I'm just combining it together on the same stock. Again, not a recommended trade because Apple has earnings coming up, as Frank pointed out on Tuesday. So I don't want to be in any position, bull put, bear call, directional, or neutral, even if I'm really far out of the money on either side because I just don't know what could happen. All right? But this is the Iron Condor. So instead of just taking a 13, 14, 15% on a bull put spread with Apple at 152, maybe selling the 135 and buying the 130, we would also do the bear call by selling the 167.5 call and the 172. So here's our bear call. Here's our bull put. Combine them together, we get close to double the net credit and a really increased return as long as the stock stays between the two strike prices and all four options expire worthless. Now, it looks great on paper. Higher return, higher net credit, hopefully, and in most cases your broker will only require you to put up the margin for one side of the spread or the other, the 5 points on the bear call or the bull put, because as a structure as itself, it can technically only lose in one direction or the other. Now, if you manage it in the middle by closing the bull put and you take a loss there and then it recovers, you can lose twice. But just as the structure here is an entry as an Iron Condor, technically you can only lose on one side or the other. But when you adjust it, you can actually lose on both. In any case, this would naturally have to outperform because we're getting the better net credit and we can win at least on one side. But there's the rub because it also gives us two ways to lose. So in the good markets, well, depending on your direction, what's good or bad. So for January, I'm making money on all my bull puts of the Iron Condor, but I'm managing more than half of the bear calls, even structuring it with that 85% probability, or short call delta of less than 0.2. It was still moving up at a pace where they'd have to be managed. And then you lose close to 80 to 90% on all the bull puts. Your risk-reward ratio is a little bit better because the extra premium, but you're losing on one side here, losing on one side here. Probably did okay in here, might have lost on your bull puts, lost on your bull puts, doing okay, but then here you're probably peaking out towards the bear call sides. taking losses or managing the bear call, so you're not making as much initial profit as you expected, even though you nearly doubled the net credit. And then loss on the bull put side, loss on the bull put side, and so on. That's why it's a little bit more hectic to trade the Iron Condors. And this market, 50-50, as a guess, I'm going to say you would have had to have managed 65% of Iron Condors during these cycles, either on the bear side or either on the bull side. Okay? So a side note on that. I had a customer call me last week and tell me they've been successful with Iron Condors starting at the 20th, 22nd or so of December into mid-January. It was around the 15th of January. Okay, and the market was moving up and stable. After the low in December, it started to move back up and was stable. Not large jumps, but the position still could have been doing okay. But again, once that first cycle's hit, the first change in the market's hit, you're going to lose on the bull put, or you're going to be managing the bear calls. Now, I personally, and I'm pretty confident Ernie as well, we here have not traded an Iron Condor since 2015. I think Ernie might have legged into one once or twice. Literally once or twice only. And it's because I was tired of managing one side or the other consistently. Even looking for spreads that had that 80% probability or higher on the bull put or the bear call side, a probability between. The probability the stock would be between the strike prices of around 85, 87%. Consistently, one side or the other had to be managed, and it wasn't worth it. I stuck with the bull puts mostly, and then shifted at once to bear calls, and then when I couldn't depict the market, as in mid-October, didn't know what was coming next, I stopped spread trading in that portion of my portfolio. But I'd love to hear from you. Right? If you've been doing Iron Condors and you've been successful, I don't want to know your criteria. I don't want to know, I'm not going to try to piggyback on your ideas. I'm going to congratulate you, but I would love to hear it because I think they can be successful. But if we're seeing a cycle, and yes, I'm pinpointing this to be fair comparisons across the same cycle we use for all of our comparisons in this webinar series, January 1st, 2018 to December 29th, 2018. It would have outperformed the bull put results we saw or the bear call results we saw. I don't think it would have outperformed the bear calls because we still would have taken those large losses on the bull puts. We still would have had to manage a fair amount of the bear calls, and the balance of the extra 20 or 30 cents of net credit into the Condor would have helped hedge the losses, but we would have been losing more frequently or having to adjust more frequently as well. Now, the last two topics I promised we were going to take a look at today was the parity trades. All right, I'm going to take a brief look at the bull call debit compared to the bull put, and maybe bear puts versus bear calls. Okay, I'm going to use power options to illustrate that. I'm also going to address an email that came in from Suresh last night. And Suresh said, when we do the spread, we are buying an option as well as selling one, and the purchase fraction of the trade limits the upside potential. If that's the case, why not just sell the naked option? Okay. Now, yes, he understands the risk will be unlimited for a call and greatly increased for the puts, but if we have an account that can sustain the risk, then the probability of trade expiring worthless will increase. What I have noticed is that a credit spread doesn't work, then I end up rolling only the short call, so the long call ends up being wasted. Okay, well, we're going to talk about that as well. So let's pause for a moment. I'm going to navigate over to power options. And let me move my screen over here so we can see it a little bit better. All right. There we go. Okay, so briefly what I'm looking at here, I'm going to illustrate this first with just a simple custom spread tool in power options. And we took a couple look at Apple. We looked at the bull put in the Iron Condor of selling the 135 put and buying the 130. Not a recommendation or suggestion because earnings are coming out in a few days, but the structure of a bull put I might use. is selling that 135 and buying the 130. Now if we take the midpoint prices, sorry folks, if we take the midpoint prices, 87, that's a little bit low, isn't it? Well, it's okay. Remember, we'd want to target up around that 14%, 13% range. This is a little bit below where it was. It was better earlier. Stock's now at 152.33. It's been falling down. In any case, I might get a net credit of around 38 cents. On a 5-point spread, it comes out to about an 8.2% return. Remember, what did we do here? We sold an out-of-the-money put at 135 with the stock trading at 152. This does leave me with an obligation to potentially buy shares of stock at 135. It can be put to me. If the stock collapses, I've tried to limit my monetary risk using leverage by buying the 130. So my margin requirement is only 500 points for one contract. If I did 10 contracts, I'd only have $5,000. Now, the true risk is only 462. I keep that 38 cents regardless of what happens. A parity trade to this bull put structure, 135, 130, would be to sell an in-the-money 135 call and buy a 130 put. Rather than receive a credit, I'm going to pay a debit. But if the stock stays above 135 at expiration, I have an obligation to deliver stock I don't own at 135, but I have the right to buy it at 130 with the call spread. So if it's in the money at expiration, I can essentially buy shares of stock at 130, sell them at 135, I get 5 points back. But I had to pay a debit to get into it. So the difference of the debit to the difference in strike prices, what I can get back, would be my profit. Now our bull put is a 38-cent credit received up front with a 5-point risk. So the true risk is only 462, and that gives us this 8.2% return. Let's reverse it. And not reverse it, we're going to do the same trade structure, same expiration, and sell the 135 call and buy the 130. There we go. Now, this comes out to be a little bit less, doesn't it? My debit to get into the trade is about 468. It's using midpoint prices, so it's breaking it down. I could sell this for 18.25 at midpoint. That's not unreasonable. 18.15 bid, 18.35 ask, 18.25 is reasonable. Bid ask on the 130, 22.80, 23.05, 22.93, 22.95 is not out of bounds. But in any case, pay about 468 debit to get into the position. Same risk-reward profile. Stock is above 135. I can buy stock at 130, sell it at 135, I get 5 points back. That's only a $32 profit, or 6.8%. We have the same probability as the bull put. The same probability the stock would be above 135, and the bull put spread or the bull call debit would be profit, max profit. Similar monetary risk, 462 versus 468. So why are we mentioning this? Well, at times, if you're interested in a bull put, it doesn't hurt to check out the parity bull call with the same strikes and the same expiration. Because if you can get the midpoints, you might get more bang for your buck with the same expectation, same probability, and if you're getting a higher return, that means you have a lower risk. But let's take a different view of this. One of the tools that we offer on power options under the spreads and our signature tools is called the spread chain. This is a more simplistic view that just shows you the combinations of the strikes that could be used to match some basic criteria, what the midpoint prices would be for a put spread or a call spread, and you can set your probability range to what you want. So let's take Apple one more time. But what we're going to do is go to this tab here, Put Credit and Call Debit Parity. We're going to leave our 5-point strike difference. I'm going to look for a minimum return. I want it to be a little bit higher, so let's go at least 40 cents. Out of the money range, okay, that's fine. Minimum return, we talked about that 12 to 13%. I really want a probability above 85%. Let's see if anything matches what we want for February 15th. Sorry, let's do Apple though. I'm going to change the symbol as well. Okay, too restrictive. Let's drop this down to 30. We'll at least see R's. Let's drop this down to 82. I want to keep that 12% return. There we go. So this is showing us the parity. On my left is the bull call debit. If I bought the 135 and sold the 140, 1810 and 1373 at midpoint, I'd have a cost basis of 437. Which means if it works out and the stock's above 140, I get the $5 back. So I have a profit of roughly 63 cents or 14.4% with an 84.9% probability. That was the one I was looking for, but it just, right now it's just below 85. That didn't want to appear. But if I did the credit spread and we get the midpoint prices, I get 69 cents, which is a 16% return. So if this is my outlook for Apple, which again is not a recommendation because we have earnings coming up, so I wouldn't do a debit or credit spread on Apple going into earnings. But this one gives us the best bang for the buck, so I would do the bull put credit. The risk-reward profile is the same when you use the same strike. So here's our profit and loss for the bull put. Midpoint, very reasonable here for the bull put credit. Again, there's that 16% return as long as the stock stays above 140. Simple graph, but it gives us a breakdown view here on the spread chain tool. The debit spread, as we saw, is only giving us 14.4, 14.3%. Midpoint is likely, but because the calls are in the money, they have a wider bid-ask spread. All right, so naturally, that's where we hit the problem, where we might not get this one here, though. 1365 is likely. 1355 bid, 1375 ask, yeah, that's likely. But again, if you get the midpoints, this one doesn't compare. But you can look at other stocks and other positions. If you're interested in bull put on a single stock, let's just try Amazon, which again, not a recommendation or suggestion, just an example. Keep the spread width, the strikes, the probability we want. There we go. So now we have multiple spreads. Let's shorten it. I just want to go to February 15th, see the ones that match it. There's a lot. Wow. It's too much, actually. So let's put our credit up to 50 cents. Okay, that narrowed it down a little bit. What I'm just trying to show here real quick is that, see, in some cases here, if you do get the midpoint, this one, the bull put's better, 13.6 to 13.4. But further down the line with the 91.6% probability, we have a 14.4 on the call debit versus 13.6 on the bull put. Might be worth it to go more bang for the buck. And remember, even though these prices are high, the debit that you'd pay is only $437. Let me clear that up. I apologize. So yeah, you're saying, whoa, 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 this is $193 per contract and $188.95. Your debit's only $437, which equates to the risk of $440 for the bull put. But this gives you a quick view so you can see which one gives you the best bang for the buck on your stock that you have a bullish or bearish sentiment on, and you're interested in doing a vertical spread. Keep in mind that in order to profit on the debit spread, you have to actively close it, meaning that you have a commission cost to enter the bull put credit or the bull call debit. If things go your way, the bull put just expires worthless. With the bull call, you'll have to enter other commissions either to sell to close and buy to close the options, or to allow assignment by exercising your long to deliver the short. Your broker might charge you a stock commission or two, depending on how they handle it. So if you're only doing a few contracts, 4, 5, or 6 contracts, keep in mind how much the extra commissions might affect the benefit of a higher return, and is it still worth it? All right, so that's a little bit on parity, and of course, as always, if you go to the free webinar section, and this is a public page, by the way, At any time, you can go to our webinars page. It's powerup.com/webinars.asp. And under the option strategies, of course, debit spreads versus credit spreads, we talk about that more. And in some of our Friday discussions that we post, the open forum Q&A, here's a presentation that'll give you a little bit more in depth into the parity than we spent today. Bull call debit and bull put parity, and further discussion on that if you want to delve into it. So under requested topics, January 8th of this year, you've got a discussion there, also management of the out-of-the-money bull call debit. All right. So let's go back to our custom spread view very quickly. And we want to take a look at Suresh's question as well. All right. I'm sorry, folks. So what I'm going to do here, let's just stick with Apple because we've been using it. And remember, we looked at a bull put. Not the one we wanted, but let's stick with the 140, 135 that just popped up on that spread chain tool. Do a bull put. If I sold the 140 put, 155, bought the 135 at 86, we get our target. 16% return, max profit of $69 over a risk of 431, almost 70 to 430. Right? That's where our target would be. Realistic expectation, and we're at a probability of around 84, 85%. Okay, now Suresh's question is, look, I could make $1.55 by just buying the 140 directly. Why do I want to take half of that away to buy the 135 put? Why do I want to take this premium away? It limits the upside. Well, what's limiting the upside is the structure of the short option. It's not that you're buying an option. What the long leg of the spread allows you to do is use leverage. Why it's so popular. And it's why I do these presentations on spreads fairly often, because leverage works both ways, and we've shown that. When we look at spreads, we've been looking at spreads with an 85% probability that have a 6-to-1, 7-to-1 risk-reward ratio. And the first thought is, well, shouldn't I do better if I get a higher net credit? I only have a 4-to-1 or 3-to-1 risk-reward ratio. And yeah, now you've lowered the probability to do that, which means that we already showed the results that you do worse. Even though your risk-reward ratio is better, the structure of the trade is not right to be consistently profit. It causes headaches. You hit losses more often because you're not as far out of the money. And so you say, oh, but when I lost, I only wiped out 3 trades. But you're losing a third of the time. That's the issue. That's what we've shown with a criteria set that worked best over a same time frame for multiple comparisons of different techniques. In any case, having only a 5-point spread limits your margin. That's obvious. But the idea is he understands the risk will be unlimited for a call. He means if he sold a call, maybe that 165 we were looking at, instead of doing a bear call, he just shorted the 165 call. The naked call technically has infinite risk to the upside because there's no limit to where the stock can go. I tell all my customers, all my webinar attendees, if I ever find the stock that goes up infinitely, I will let you all know right away so we can all enjoy the benefits. I haven't found it yet. But yes, technically a naked call has infinite upside risk. That's what his comment was referring to. But he says if you have an account that can sustain the risk, the probability of a trade expiring worthless will increase. No, the probability stays the same. And if I just sell the put, I make 155. But now for just one contract, I have to put up $14,000 in order to make 155. This is only a 1.1% return. Why are you, I don't want to say why are you here, why are you joining me for webinars on spreads? It's because you want to use spreads to take advantage of the leverage. Although we look at it and you can say, yeah, but in order to enter the spread, you had to take more than half of this premium that you wanted, this reward away, to buy this option that you're just hoping expires worthless. And it's to use leverage. Why would you buy options instead of just buying 3 or 4 shares of stock? Because you want to use the leverage, right? That's one of the faults. This is a naked put. Naked put is a good neutral to bullish strategy. It can be successful as well. naked puts are capital intensive. And even if you tell me that, hey, well, this $14,000 for one contract, why is that margin there? Well, I've entered an obligation where I may potentially have to buy shares of stock at $140 per share if it falls below 140 at expiration and I don't manage the naked put. Yes, we're still at a reasonable probability of 84, 85% that it would stay above that. But if the unexpected happens, another February 5th to February 9th, 2018, and October 3rd, 4th, and 5th of 2018, you might find the stock trading at 135, 134, 130, 128. So yeah, if it's trading at 135, you still just took the 5-point loss and you got a $1.55 premium. You're doing better than the bull put. But if the unexpected happens and it collapses down to 128, you're taking a 12-point loss for 155. How many spreads would that have wiped out? The 12-point loss might have wiped out 10 trades of just the naked put. And you may tell me, well, my broker only requires me to put up 50% margin on a naked put position. Okay, so now you're putting up $7,000. On the spread, the margin is still $500. Okay, so if you have the capital, you don't mind owning shares of stock at this price, you could do that. But it's going to be more capital intensive. That might be okay if you're not, interested in diversifying to other positions. But I personally, I can't speak for everyone in the room, but I personally use the naked put strategy if I'm looking to potentially own shares of stock at a discounted price. I do fully cash secured if I do sell a naked put in my portfolio, so I don't take the risk of margin and watching the stock fall and then having to scramble to find another $7,000, $4,000, $5,000, but it's probably on 3 or 4 contracts, so it would be $21,000 or so forth, taking away from other allocations of my portfolio to cover the need to buy the shares of stock if I get assigned early or the stock put to me. Okay? Yes, we're going to talk about, in the next month or two, we're going to talk about naked puts. We're going to talk about covered calls and criteria, just as we did with the spread positions as well. But to me, this is a different strategy. This is a different approach. I'm using bull puts to take advantage and bear calls to take advantage of the leverage to follow a direction, only trading a few contracts, only allocating 15% or so of my portfolio for this leverage strategy that we've shown with the right criteria and the right structure can be successful. Okay. Now, and then the naked call, of course, this is a little bit different. Many of us might not even be able to do naked calls. We mentioned the 160. Let's do the 165. So instead of doing a bear call, 165, 170, if I just sell the call, I'm still going to have a monetary obligation. It's going to differ a little bit. But I know a lot of brokers won't even allow you to trade naked calls unless you have a minimum total portfolio value and you're up at level 4 trading if you're not already, or sometimes it's even level 5 depending on how your broker breaks it down. It's not a consistent approval of the different levels. It varies from broker to broker based on what you have. But the naked call side, okay, so I'm taking in $97 instead of leveraging and using the 170 call and taking in only, let's say, 40 cents or maybe 30 cents, 35 cents or so. Because the monetary obligation and the return on investment might not be matching, doesn't match the goals that I'm using for this allocation in spreads. I don't trade naked calls and I never have. Not because of the infinite risk, just because I think it's better to do a bear call. I don't have the proof in the pudding for you. I could run a test and I might, just to see how that, take the winning bear call criteria and how would have that worked on the same stocks, with or without a stop in place, if I just sold the short call to begin with. And on the bull puts, comparing it to naked puts. But again, I have to keep in mind that the monetary requirement is going to be higher. So I might not be doing as many contracts. might not be taking in as much premium, and my return is going to drop to 1.5% from the leveraged return on investment of 13, 14, or 15%. That was our target we discussed in Beyond the Basics Part 1. Okay, so that's the best way that I can answer that, Suresh. I think it's because it's a different structure. You do have the same probability. We talked about that bull put spread on Apple versus just doing the naked put. You have the same probability unless there is a drastic fall, which we saw 5 cycles of in 2018. Just as a reminder of what can happen. Serge's comment on YouTube is correct. 2019 will not be 2018. We don't know what kind of wild swings we might see, or if we see no wild swings. But where we're trying to lead you is to, if you're doing spreads, if your interest is in spread trading, you're just getting started, you're looking to improve your spread trading, what we've shown in these past 2 presentations is where we feel our guidance would take you. This is the same thing I would say if you called me up for a coaching session. If you called us up here at the office, or if you sent me an email, say, hey, I'm looking to start spread trading, what should I look for? This is where I would guide you. Because over the same time frame, over various time frames in different years, we've been able to consistently show that the criteria we've been discussing have outperformed bull puts or bear calls over the same time period when you look for higher return and lower probability. And to Suresh's question, are you losing money when you buy the option in the second leg of the spread? Yes, you're taking away from the premium you did, but to give you the leverage so it's not overly capital intensive, and you don't have as high of a monetary risk on the position. Though the percentage at risk would be lower. If the stock did fall, if Apple did fall, to let's say 132 and I'm in the bull put credit, well, I'm losing 8 points. I collected $1.55. But if I allocated $14,000 to it and I lost 8 points, or 800 on one contract, that's not a bad percentage loss. Whereas in the spread, if it dropped to 132, I've lost the full amount of the bull put spread, that $500 monetary requirement, really 462 with a 38 cents taken in, of course. But yes, that now you're looking at a 7-to-1 or so risk-reward ratio, almost a 10-to-1 risk-reward ratio in that case. Well, okay. But again, it's only $462 as opposed to $800. But the percentage is higher because I've lost 100% of what I had in the spread. So, Suresh, that's my answer to you. I think it's a different approach. It's something I would do a different allocation in my portfolio with different expectations going forward as well. All right. Well, ladies and gentlemen, that basically covers what I wanted to share with you today. So what is next? Well, naturally, I'm sure you're going to have questions, comments you want to make. Remember, you can email us to any time to support@powerop.com. You can also call us during market hours at 302-992-7971. Remember, if you're on a trial, you're a member of Power Options, you can schedule a coaching session at any time. Beyond that, well, soon we're going to take a look at the trigger points or the stops that best solve the needs for credit spreads. And we touched on that earlier. What do I want to use a stop for in a credit spread portfolio? Well, I want to increase the return percent by lowering the losses. I definitely want to decrease the average loss on the positions that go against me. And hopefully that's going to increase the number of wins. And then later on down the road, we're going to follow that up with some management ideas on the spread positions. Some we already showed, but what I want to do this time is I'm going to take a look at those 9 or 10 losses we saw in the bull puts, or the 15 losses we saw in the bear calls. When they occurred, what happened, and what we might be able to do as far as management and ideas for management, but beyond ideas for management, when to maybe use one management over the other based on the results that we saw. All right. Now, I just want to remind everyone, if you've not done so yet, remember, head on over to Power Options, powerop.com, and start your trial. Just need your first name, last name, and email address. You'll have 14-day full access to Power Options to access the search tool for bull put credits, bear call credits. Use our default criteria as a stepping stone that we reviewed, or create your own criteria to see what you need. And of course, you can also access that spread chain tool that we showed today to help you with decisions on maybe using the parity trade, the bull call debit instead of the bull put, maybe the bear put debit instead of the bear call. Plus, you also have access to the portfolio tools for tracking and managing your positions and much more. No credit card required. Remember, just go to powerop.com, name and email address, start your trial, and then, of course, you'll be able to see more information and education as well. Ladies and gentlemen, thank you for joining me today. I hope you got some useful information out of today's webinar, Credit Spreads Beyond the Basics Part 2. This will be archived, was recorded of course, and it will be posted this afternoon, and I'll send everyone an email when the webinar is available to review on the webinar archive page or on YouTube as well. Take care, everyone. Have a fantastic remainder of your week and a great weekend, and we'll see you soon. Good night.